Hi there. We're solving AS Accounting paper 2 from February March 2024. Um, and one thing I've done here is I've moved around page number 3 and 4 because on page 4 you have to do the workings. So I've just moved this before page 3. There's page 3 so that I can first show you the workings, and then I'll just flip it back again and put it into that sequence. Now, before we start, I'd like to remind you that we have live online classes for which you can register on our website, www.jadidinstitute.com. There's a spelling for that. And yeah, let's begin. The following trial balance was extracted from books of V Limited at 31st December 2023. Should always know the year end. That helps you out. Okay. 8% debentures. 8% means the rate of interest on those debentures. That means when it is repayable, right? So currently it's 2023. It's a long-term liability. There are some administrative expenses, a bank loan and a bank loan interest. We might have some adjustment to these later. We don't know that for sure, but we'll see. That's then we have some other expenses, some assets, some liabilities, of course, and a bunch of other things. And then we have some information on closing inventory, distribution cost include prepayment, accrual adjustments, depreciation, more adjustments for accruals, prepayments. The debenture had been issued on 1st October 2023. Now the year end is 31st December, and the debentures were issued on 1st October. That means October, November, December. That's 3 months. 3 months of those are for the current year. What I mean by that is we'll take 3/12 of the interest rate. Okay. The first payment is due on 31st March 2024. So what does that mean? That means at the end of the year, this will be unpaid. So this will go to your SOPL as an expense or finance cost actually. Okay, 3/12, and it will in your SOFP statement of financial position, that would be your current liability. Why? Because it's unpaid and will be paid on 31st March. So at 31st December, you were supposed to pay 3 months of it. You haven't, so that becomes your current liability. Okay. And then there's tax for the year, which is a bit rare in your syllabus. In AS, they don't really bring in taxes a lot, but if you go to the next page, there's just a column. There's an empty space. There's a row empty space for that. So it's easy marks. Okay, easy pickings. Let's go back here. We have a section for cost of sales for which we need some elements, isn't it? We have opening inventory. Opening inventory. Let's see what we have. Opening inventory is 47,800. Let's put a tick next to it, or actually here. 47,800. 47,800. And then we need purchases. That would be, let's look for anything related to purchases. There's carriage inward, right? That's relevant. I'm going to mark it like that. We have purchase itself. Do we have any purchase returns? I don't see them yet. Returns. It just says returns. Now this is interesting. Wow. So returns on the credit side, since it's a trial balance, it's not just a random list. It's actually a trial balance. So purchase, there should be purchase returns, right? Purchase returns. Because purchase returns are the ones which have credit balance. So that's relevant. And then we have, do we have anything else about purchases? No, it looks like that's it. So from in purchases, you have 522,000 plus carriage inward. So that's taken 4,500. Minus that 5100. Okay, that's opening inventory plus purchases minus closing inventory, which is simply 49,500. It's always a bit scary when you think you're going to miss out something, so let's just give it another look. No, we're not missing anything, so that's it. We're safe. And by the way, most of the marks, 14 marks, is for the workings, isn't it? So make sure you perform them well. Okay, you perform them with focus, and at the same time, you don't waste too much time on them, because you have about 1 minute per mark, right? If you realize, so if you want to leave some space for rechecking your work, you have about 1 minute per mark. So just be a bit careful with time management. Let's add it all up. Gonna have to open up my calculator. Just give me a minute. It says 522,000 plus 4,500. Is that 4,500? Yes, it is. Minus 5,100. That's 521,400. 521,400. Okay, so cost of sales is opening inventory, which is 47,800, plus purchases 521,400, minus closing inventory 49,500. That's 519,700. 519,700. Okay, done with some of the things here. Let's mark that. What else have we picked from here? We have taken... That's it? Just the closing inventory? Yeah. So that's it, yeah. Distribution cost now. Pretty sure there are some adjustments. I mean, that's why they have the workings tab here. So the opening distribution cost is 3,700. Like, that's what's provided. 30,700. That's what's given to us. We'll of course make some adjustments to it from here on. So carriage outward should be part of distribution, 8,700. Okay, that's taken. And anything else about distribution? Sales staff. If there is no specific space for wages, then we have to put it in one of these, right? So if we had to put sales staff somewhere, we would put them under distribution cost. So 38,300 goes there. Must make a tick, because we're not going to keep, we'll not be able to keep track of what we've already considered. What else? Distribution costs include prepayment of 6,000. That needs to be removed. It's prepayment. It belongs to the next year. Minus 6,000. What else? Rental income, that has to do with income, nothing to do with this. There's some proportion of that depreciation that goes to distribution cost. Okay, that's a small challenge. We'll deal with it in a minute. Okay, I think that's it for distribution. Let's just make sure. Okay. Furniture and equipment at carrying value. So at the beginning of the year, we have a carrying amount, or net book value is the same thing. You should know that by now. 956,000. And it says the policy is 20% reducing balance. I think this is too easy. They're not challenging you. 956,000 times 20%. 956,000 times 20%. You can even write 0.2 times what proportion belongs to distribution. That's 40%. So you may take 0.4 or 40%. That gives us, we'll have to see, 956,000 times 0.2 times 0.4. 76,480. A lot of depreciation. But that makes sense because it's 20% of almost $1 million. So it's got to be high. Okay, so we add that to distribution cost. 76,480. If we add it all up, it comes down to 30700 plus 8700 plus 38300 minus 6,000 plus 76,480. That's about 148, 180. You know what? Always try to see if your answer makes sense. Okay. So if I got something in millions, then I would be like very skeptic of my answer because things are in. You can just get a rough estimate, right? That's about 80,000, about 30,000. So under 10,000, and then 38,000 minus 6,000. So just get a rough estimate, just so that your figure is not some irrelevant number, right? So always look at your answer and be actively looking at whether that makes sense or not. Okay, that's for the distribution cost. Now moving on to administrative expenses, starting with what we have: 17,200, and then we have, that's finance cost. That's income. Okay, wages. It's 49,300. That's taken. That's income. Okay, we'll take 60% of that. Oh, office wages were due but unpaid, so we add that 5,800. Okay. What else? That's it. Not so hard, is it? So add 5,800, and also we need to add the depreciation amount, which is the same as this, but instead of that we have 60%. 956,000 times 0.2 times 0.6. I really hope you guys understand how that works. 956 times 0.2 times 0.6. That's 114,720. 14720. That's 114,720. Let's add it all up. 114,720 plus 5,800 plus 49,300 plus 17,200. 187,020. 187,020. Finance costs, we have, wait, I need to recheck before I move on. That's taken completely. Okay, that's taken. In finance cost, let's deal with finance cost now. We have the bank loan interest, which is given as it is, 2,600. Now we need to take debenture interest, which will be 240,000 times 8%. You can put 8%, but I'm going to show you something different. You can put that as well. Times 3/12. Why? Because this was issued on 1st October, and this is currently we are at 31st December. So October, November, December, that's 3 months. Let's see. 240,000 times 0.08 times 3/12. 4,800 plus 4,800, and they've told you this is unpaid, so just be careful later on. 4,800 plus 2,600, that's 7,400. Okay. Are we missing something? I really hope we're not. Moving on. Let's put things into the income statement now. So revenue, we do not have any returns. They just tricked you here. They left it, that left it like that. They didn't tell you whether it's purchase or sales return, but we figured out it's purchase return. So we're going to put revenue as it is, 997,100, 997,100, 997,100. Cost of sales. Cost of sales, we got 519, 519,700. Is that 519,700 or 200? Okay, I'm gonna go with 700, but I hope it is not 200. It's 519,700. Of course, you're gonna subtract that. You'll get gross profit. For the other income, you have its own calculation. You have rental income, for which you don't even have space, but you're gonna still show you're working somewhere. So your rental income 13,300, of which it says 3,000 is received in advance, so that belongs to the next year. So 13,300 minus 3,000 is 10,300. That's 13,300 minus 3,000. Okay. Administrative expenses, we also got that, of course. Administrative expense. Over here, we took 114,720 instead of 187,020. Well, just follow through that for the rest of the video, because that's the right figure. 187,020. This is 114,720. Distribution cost 148,180. Finance is 4,800. No, it's not 4,800. Why am I mixing it up? So, you know what? In the exam also, you can make such mistakes. Be very careful. Always point out where your answer is. 7,400. Subtract it. Profit before tax. What's the tax amount? 27,900. Okay, now we're just gonna add things up. 997,100 minus 519,700. That's 477,400. From there, we're gonna add 10,300. Subtract 148,180 because it's an expense. Subtract 114,720. That's 224,800 minus 7,400, 217,400, and then of course minus tax, minus 279,000. That's 189,500. Okay, that's for the first one. Now let me rearrange the pages. I mean. Did it rearrange? No. Well, it's not a big deal. We can leave it as it is, but we can still try. No, it's not working. Okay, we'll try to manage. During the year ended 31st December 2023, the following transactions had been recorded in the books of accounts. We made a rights issue and there was revaluation. Okay. On page 5, we need to make a statement of change in equity. Okay. So first thing, we can put the retained earnings, or we can put that later. In the retained earnings, we can put profit for the year, but not now, not necessarily now. We can do that later. Let's read that again. The rights issue had been made of 1 ordinary share for every 3 ordinary shares currently held. Okay. 1 for 3. The issue was made at a premium of 0.05 per share. The rights were fully subscribed. Okay. So rights issue is 1:3. And the current number of shares, look at the number of shares, right? So the current number of shares is 4 million divided by 0. Oh, they are all, sorry, that's the number. That's the value, right? So a million divided by 0.25 will be 4 million currently in issue. And there's 143. You know what? This is tricky. And be very careful with this. So the 4 million in issue is at the end of the year. You hear that? That's at the end of the year. That means this does not represent the original before the right number of shares. This is after the issue. So after the issue, 3 was existing and 1 new was issued. So this is basically rights. This is old and this is new, which is 4. Hopefully you understand that, because for every 3 old, 1 new was issued. So that turned your shares to 4, right? In terms of ratio, let's say. So this represents the new number of shares. Okay. If you just want to know the rights issue, what you would do is 4 million divided by 4, because in ratio, this 4 million represents after, right? So the point is, it can be divided by 4 to get the value of or the number of shares before the rights issue, which is going to be 3 if you multiply that by 3, or if you multiply that by 1, you will get the rights issue itself. I think I've overcomplicated. If you know the basic maths behind ratios and how they work, you should understand that this is simply 3 million old, 1 million rights issue combined, they became 4 million. Hopefully that makes sense, because that's the ratio, right? Fine. The issue was made at a premium of 0.05 per share. So premium 0.05 means for that 1 million, 0.25 will be the share capital. That's going to be, well, what's that going to be? It's going to be 250K, 1/4, basically, 250K. And the same 1 million times 0.05 is the share premium, which is 50,000. Total money raised is 300,000, but that's your share capital. That's your share premium. Okay. A bit tricky, isn't it? But yeah. So this, even they've put this in bold. It had been recorded. It's already recorded in that ratio. After the issue, we had 4 million. That means before the issue, it would be 3 million, and 1 million would be the issue if you want that ratio to be to hold true. So I'm really hoping you understood that. It's not that tricky. You just need to know the basic maths behind ratios, and you must understand that this represents after issue, not before. Okay, so 250K and 50K. 250K and 50,000. That's a total increase in equity of 300,000. Okay. When did that happen? Let's see. On 1st September. September. Oh, we don't have to put that. We actually can say that that's rights issue. Rights issue. And then property had been revalued and the value reduced by 60,000. Property had been revalued and the value reduced by 60,000. Do we have any existing revaluation reserve? Yes. If only if we have existing revaluation reserve, we're going to deduct it out of this. Otherwise, we would deduct that fall in value from our retained earnings, right? Actually, we would have recognized that as an expense if the property is valued downwards and we do not have any revaluation reserve. So revaluation downwards, of course, you can write that if you have space for this, but this is good enough. 60K. What else? Is that it? No. We also have dividend. 37,500. I was almost forgetting that. Almost going to forget that. Dividend. What is it? 37,500. 37,500. 37,500. Okay. What else? Retained earnings at the beginning was 174. We know that. It's already there. Share capital. Oh, we have to also fill in these blanks, I think. Oh, never mind. Yeah, I mean, we can. Well, that's going to be 750K as a missing figure, if you would really want to put it. And that's, well, 215 minus 50. I think we have to find that. It wasn't made that obvious. Maybe it's written above earlier. But let's see about that. 50, that's 165. 165. Okay. Complete this. So yeah, we need to complete it. That's what they say. So probably there are marks for that, what we just did. We are not making here any SOFP, so I don't know why they gave us that information. It's just bothering me a little bit, like we didn't use that, but we'll see about that. Okay, just like that, we also have these unpaid. Well, if things are unpaid, they go under other payables and so on. So there are a bunch of things which belong to SOFP as well, just so you know. That's not part of this question, I hope. Yeah, we don't have that as part of this question, but you can expect to face that as well. Now, finally, we have your profit. 189,500, 189,500, 189,500. Oh, not deducted. 189,500. Okay, what are we missing? Anything? Bank loan? No. We're not making SOFB. Moving on. Rental income, we considered that. Share premium, considered. Trade payables, receivables. See, this is just unused in this question. We didn't use this information. Depreciation, use that. Okay. Yeah, we're not missing anything. I hope. It doesn't look like it. Although there's this empty space. Is there any transfer to general reserve? Anything like that? Just want to get it right. Property at valuation 980. Well, no, that doesn't matter. Okay, any transfers taking place? No. Any information here? No. So we are safe to move, it seems. Let's just fill in all the blanks. The top column first, the top row, I mean. 750 plus 165 plus 60 plus 174, 1149. 1,149,000, of course. Let's add everything. Vertically, that's 60 minus 60, 0. Okay, gone. What about the retained earnings? 174 minus 37.5 minus, not minus, sorry, plus 189.5. 189.5. Gives me 326. Okay, so 326,000. So 1 million plus, so I'm just going to put 1,000 plus 215 plus 326. It's 1541, 1541000. You may also confirm that vertically like that. Add it all up, see what you get. 1149. Okay. 300,000 plus 300,000 minus 60 minus 37.5 plus 189.5. 1541. It adds up. Hopefully no mistakes, no issues here. Let's keep moving. Say two factors that the directors should take into account when declaring dividend. Well, they should look at their liquidity position. So do they have the cash? Liquidity. Okay. See if they have the cash for that. Look, this is not enough. Okay, but I'm not going to write everything. I'm just going to say liquidity position, cash flows, and so on, right? Secondly, they can look at the distributable reserves. As you should be aware, revenue reserves are the distributor reserves, or maybe they should just look at the retained earnings or profit. Any of these should work. Okay, so if you write down if they've made enough profit during the year, if they have enough retained earnings during the year, if they have enough distributable reserves, that's also fine. The directors wish to improve the company's performance. They are considering two options: option A, option B. Delaying payments to credit suppliers by an extra 8 days. They will be unhappy, right? Switching to a new supplier who's prepared to offer a trade discount if large orders are made. Let's see. So 7 marks. Advise the directors which option they should choose. Justify your answer by considering both effect on both profitability, liquidity. Okay, let's see. They want to improve company's performance. They're considering two options. Do we have any? Can we use any context from here? What is their position? Well, it looks like they have a lot of debenture. That's one thing. On top of the bank loan isn't much, but still we have a lot of debentures. What about the payables? Our payables are 57,800. Well, if you want to make calculations, you might make calculations of certain ratios, like perhaps well, no, never mind. We don't have information on whether purchases are on credit or not, so I don't think we have to really use calculation. It's mostly non-financial factors. So to improve company's performance, two options. One is delaying payments to credit suppliers. What implication will that have on our liquidity? It will be good for us. That will basically, it will give us some extra time to pay back our suppliers. We can retain that cash. We can use that cash to reinvest in the business, right? And we can also use that cash for other purposes, right? So basically, it's going to help with our working capital cycle, delaying payments to credit supplier by an extra 8 days, right? That's on the liquidity impact. It's positive, right? So write positive things about that. Profitability, however, that we can write more about. So maybe you can write a point about that and a couple points about this for this option A. Profitability, this is bad for profitability. One is you might face interest charges from the supplier. Supplier will say, give us interest because you're paying too late. And on top of that, you may also lose any discounts. If previously you were getting discounts from the supplier, now you're going to lose that. Okay, so that, and on top of that, you will face difficulty getting credit in the future, isn't it? So all these factors, really easy to come up with 3 points for both of these aspects for option A, and of course for option B as well. Let's have a discussion on this. Switching to a new supplier who's prepared to offer a trade discount if large orders are made. Now, look at the implications of that on profitability. It will increase profits, right? It will increase profits because cost will fall, and if costs fall, profitability will increase. That's one thing. It may also reduce profitability because it will lead to larger or higher storage costs, right? So it will increase storage costs, which is an expense, will affect profitability negatively. But at the same time, we are getting things for a cheaper price, and so it's going to help the profitability. What about the liquidity? Well, um, for liquidity aspect, you can say that it will worsen liquidity because we're going to have to make larger payments now, right? More of our money is going to be stuck in inventory, isn't it? We're ordering larger sizes, more money is stuck in inventory. Also, we have greater payables, right? Larger payables. Although it's lesser, it's going to be cheaper comparatively, but since we are purchasing a lot now, we have higher payables. So it looks like uh, option A looks slightly more attractive. It's up to you, really. You can justify any one of them. Maybe you can justify this one. You can say, well, there's going to be more profitability and we're not paying late to anyone, because no such thing is suggested here that we're going to pay them late. It's just that we're going to place a large order and they don't mention anything about paying late or not. So option B, nobody's becoming unhappy. The new supplier, although we can say there is a reliability issue. So if products are not reliable, or the quality is not good enough, then also your profits can fall. So you can write a bunch of things about option A or B, and the conclusion is up to you. Whatever you choose, right? Whatever you like better. It's really up to you. There's no one right answer here. Okay? It's truly your choice. Okay, that's for question number 1. We'll try to make the other questions, although I'm not sure of that. I can't promise, but I'm going to try. Okay? Take care. Good luck with your exams. Bye.